Okay, folks, welcome to Volume 5 of the Inner Circle Traders Market Maker Collection. Okay, in this installment, we're going to be dealing with more insights as it relates to institutional order flow and specifically on mitigation blocks. Okay, the ability to discern when and how financial markets will move can be confusing. Now, there is a fundamental point that first must be understood concerning price on any asset class. This foundation is that large financial entities such as central banks, private institutions, and companies have a large influence on the action seen in price. Institutional order flow is the concept that we analyze the market structure and environment with on any asset class that we elect to speculate in. Now, before we lean on the tenets of traditional and technical analysis, we first must determine who would benefit from such a price action, move up or down. We will be covering some of those concepts I've employed at the time of this presentation over the last 2 decades. Some of this material may unsettle you. Some might shock your treasured opinions on how the marketplace trades in what appears to be a free marketplace. I make no apologies for telling you the hard truth and how it plays out daily in the market. Okay, understanding ICT institutional order flow. Now, when we talk about institutional order flow, it really it's been a little bit of a challenge as it relates to dissecting it in a way where you guys can understand it. Uh, when you're only exposed to the retail side of it, it's a little difficult to you know come away from the charts from just outside of indicator-based in analysis or input into your own trading plan. But when you look at institutional order flow, as I like to refer to it in all of my material, I made it in such a way in this presentation to break it down into 4 major spectrums. Okay, the first obviously is understanding that when we look at price, we are not looking at the retail universe moving price. Again, it's deep pockets that make these markets move, and we want to basically looking at the market when these individuals or entities come to the marketplace to take a trade. Now, the first segment of institutional order flow is obviously the business transaction side, and this is primarily focused on commerce. For instance, if IBM wants to do business in Japan, they have to convert their dollars to yen to do business with that particular country or within its borders. Um, the next realm of institutional order flow is obviously in speculation. We like to see a neutralization of speculators in the marketplace because as we discussed in the previous module in this series, we understand that stop runs and raids on stop loss orders can produce a injection of volatility that we like to use to fuel our trades. The next spectrum of institutional order flow is that fact that it provides liquidity. Okay, and the price action that we are studying, okay, we're looking for clues as to where the market may be looking to absorb new liquidity or inject or engineer, as we'll learn in this particular module, new liquidity. And the primary function of that is to manipulate price, okay? Because if they can manipulate price, that will incite all types of traders to the marketplace, whether it be bear or bull. It doesn't make a difference to them. They just need the volatility to induce new buyers or sellers. And the last in the spectrum that we understand as an institutional order flow is the fund flows. In other words, the major hedge funds and institutional funds, when they're in their trend following course of action in their trading model and plan, um, the smart money will be hedging against that. And you'll see that also in institutional order flow. So all these components collectively is what we like to break down and digest price action with. Okay, so it's not limited to just looking at a support and resistance. It's not limited to just looking at an ICT optimal trade entry pattern or ICT reflection or any of that. It's not even important without having the understanding of why should the price move and what institutional basis is behind the supposed move that you're looking to partake in. So when you're engaging the market, you're not going to be looking for, a neon sign or a billboard saying, "Hey, look, here it is." But they do, in price action, leave telltale signs of what it is that you're trying to do and induce new liquidity or neutralize existing liquidity to take on those positions themselves. Okay, so by studying the concepts that we've already employed in the first part of this series and the new material that we're reducing to into smaller components, that will be a huge increase in your understanding and growth as an insightful trader. Okay, institutional order flow. We're going to be specifically dealing with a multitude of specific concepts in this module, and while we will be introducing them here, we will be utilizing them in a much more framed approach in later videos in this series when it gets to specific trading tactics like day trading and short-term trading and such. But the first one we're going to be talking about is pools of liquidity or liquidity pools. I introduced this concept on baby pips back in 2010. And if you've followed me for a number of years, I talked about how above previous highs and lows and previous daily highs and lows, there will be pools of liquidity that they'll many times reach into to draw new traders in or pull them out of existing positions to facilitate new price swings. And we're going to talk in a little bit more detail about that and how it is useful to us in institutional order flow. And we're going to talk about voids of liquidity. Okay, when price action is very thin, okay, it creates a liquidity void, and what will happen is that insight is very, very useful to us, especially if we have a directional premise, because we will not be chasing that price action, but we will be utilizing it to frame a future trade should certain components fall into place, and we'll discuss that second in this series installment. We're going to talk about injecting liquidity. How do market makers do that? What's the function behind them injecting new liquidity? And we're going to be talking about neutralizing open float. And we're going to talk specifically what about float and what is it? And neutralizing pending float. We're going to show the idea how market makers engineer liquidity. Okay, and more or less, it's almost like remote control for retail traders and less informed traders, how they can basically steer them into taking a trade that's really in the wrong side of the marketplace. And controlling the board, how the market makers control the entire FX universe by controlling the majors. Okay, and crouching outside the order block. When we talk about the central bank dealers range and Asian range and consolidations, when there's equilibrium in price action, many times that's a telltale sign that we're about to engage a new order block, and that will be the catalyst for the new surge in price. And we'll talk more about that in this particular installment. And obviously the central bank dealers range, as I just commented on, we're going to be talking about that, what goes on during that time of day. And institutional pricing, how to specifically hone in on the actual price levels that we like to look at when it deals with institutional order blocks or in larger consolidations. And we will be discussing the mitigation block. And finally, in this video, we will be closing it with the introduction to the breaker. Okay, when we look at price action on a chart, and in this example here we have the British pound USD, or what we like to call